Borrowing money has always been part of life, but while our grandparents had to wait in line at banks, today, a simple tap on your phone can get you a loan in minutes. Welcome to the world of digital credit and online lending. But how exactly is this different from traditional lending? Let's compare. Lending is the process of providing funds to individuals for personal growth or for business growth, with the expectation of payment, usually with interest. Now, let's discuss about the difference between traditional and digital lending. Traditional lending refers to the old process of borrowing through banks and financial institutions. It usually involves in-person applications, a lot of paperwork, and credit checks before approval. Next, digital lending is the modern approach that uses technology and online platforms. Borrowers can apply through mobile apps or websites where systems use automated credit scoring and quick verification. The main advantage of traditional are trust and security, while digital strength are speed, convenience, and wider accessibility. However, the process is often slow, requirements are strict, and access is usually limited to people who already meet certain qualifications. But for digital, there are downsides: cybersecurity risk, lack of personal interaction, and sometimes hidden charges if customers aren't careful. The future of lending will likely be a combination of both, where banks use digital tools while keeping their trusted image. So, how do these apps know if someone is trustworthy enough to lend? The answer? AI-powered borrower profiling. Instead of stacks of paperwork, apps use data. Your phone activity, payment history, even how you pay bills, these form your digital footprint. With this, AI creates a risk score in seconds. Think of it like a smart credit judge that checks if you're likely to repay. This makes loans faster and more inclusive, even for those with no traditional credit history. In the Philippines, millions of people still struggle to get loans. Why? Because traditional banks depend on credit histories, documents, and collateral, things many Filipinos don't have. But technology is changing that. Enter digital borrower profiling and AI-based risk scoring. Digital borrower profiling is the process of creating a financial identity for a person using digital data, unlike traditional profiling, which focuses only on bank records and credit scores. This method looks at the borrower's day-to-day financial activities. This gives the lender a clearer, more accurate picture of how responsible a borrower is with money, even if they've never applied for a loan before. Once the digital profile is created, artificial intelligence takes over. AI-based risk scoring uses machine learning to analyze thousands of data points, detect patterns, and calculate how likely someone is to repay a loan. AI is fast. Approvals can happen in minutes. Accurate. AI learns from past repayments and adjusts predictions. Inclusive. Even people without credit history can now qualify. Let's take a look at this example. Let's meet Maritas, a sari-sari store owner in Rizal. She has no bank account and has never applied for a loan before. Traditionally, she'd be rejected. But her Gcash shows steady income from store sales. Her Meralco and Maynila bills are always paid on time. The AI sees these patterns and rates her as low risk. Thanks to digital profiling and AI scoring, she secures a small business loan, helping her grow her store and provide for her family. This system isn't just for individuals, it also helps small businesses. In the Philippines, it can be applied in many ways, like microfinance loans, Fintech platforms, SME loans, and cooperatives. By expanding access, this tool helps unbanked and underbanked Filipinos take part in the formal economy. Digital borrower profiling and AI risk scoring have advantages, but it also have challenges. Lenders should secure personal data, ensure fairness, comply with BSP and privacy rules, and promote digital literacy to keep lending safe and inclusive. Digital borrower profiling and AI-based risk scoring are transforming lending in the Philippines. By using technology to see beyond credit scores, we can build a more inclusive financial system. One loan, one family, one business at a time. But when data and money are involved, regulations must step in. So, we'll make sure everything is fair and legally here have become popular in the Philippines because they make borrowing money quick and easy. But with this convenience comes the need for strict rules. In the past, some lending apps use abusive tactics, harassing borrowers, misusing personal data, and charging unclear fees. That's why the Securities and Exchange Commission regulates all online lending platforms in the country. Together with the Bangko Sentral ng Pilipinas, National Privacy Commission, and Department of Trade and Industry, they work to protect borrowers, ensuring fair lending practices and trustworthy digital finance environment. It authorizes, protects, and legitimates to ensure safe lending regulations toward loaning apps. Here are the clear regulations these apps must follow. Republic Act No. 9474, Lending Company Regulation Act. All lending apps must be registered with Securities and Exchange Commission and have a certificate of authority to operate. Republic Act No. 3765, Truth in Lending Act. Lenders must fully disclose interest rates, fees, and penalties before the loan is approved. No hidden charges. Republic Act No. 10173, Data Privacy Act of 2012. Apps must protect users' personal information and cannot access contacts or files. Borrowers' contacts, photos, and files cannot be misused. Republic Act No. 11765, Financial Products and Services Consumer Protection Act. Protects borrowers from abusive collection practices and ensures transparency in loan terms. Harassment, threats, or public shaming are strictly prohibited. As a borrower, you have the right to know the full loan terms upfront, have your personal data protected, and report abusive apps to the SEC and the National Privacy Commission. Securities and Exchange Commissions regularly monitor lending apps, removing those that break the rules. Apps found violating regulations can face penalties, suspension, or even a permanent ban. Still, not all apps play by the rules. Some may be scams, and here's how you can protect yourself. Digital lending is transforming the way we access credit. From mobile loan apps to online financing, getting a loan is now just a few clicks away. But as digital lending grows, so do digital scams. Scammers are using fake apps, phishing, identity theft, and even impersonating debt collectors to trick borrowers and lenders. That's why scam prevention is critical, especially during the credit and collection process. From the moment the loan is applied for to the time it's repaid, every step must be secure. Lenders are now using tools like eKYC, fraud detection system, and secure communication to fight back. Borrowers also play a role by staying alert, using only trusted platforms and protecting their personal data. And with strong regulations, smart technology, and user awareness, we can build a safer digital lending future for everyone. Here are extra steps you can take to protect yourself today. Verify the source. Always double-check the app's developer name and read reviews before downloading any lending application. Enable multi-factor authentication. Add a second layer of protection beyond passwords or PINs. Monitor your credit report. Regularly review your credit score and report for any unauthorized activities. Report suspicious activity. If you encounter a scam, immediately contact your bank, the legitimate lender, and local authorities such as your country's cybercrime unit. Remember, prevention is a partnership. By staying vigilant and informed, you help create a safer digital lending environment for yourself and your community. Stay secure, stay informed. Let's stop digital lending scams before they start. Now, let's shift to the brighter side. Legit and trusted fintech platforms you may already know. Popular fintech lending apps in the Philippines. Fintech lending apps in the Philippines include Tala, Cashalo, and even Gcash. We will briefly discuss each app, but now let's talk about the Tala app. Tala is one of the first apps to offer small and quick loans straight from your phone. For first-time users, Tala offers a loan of 1 to 2,000 pesos. If you repay on time and build a good record, your credit limit can grow up to 25,000 pesos. Another popular choice is Cashalo. This app is known for its fast approval, making it easy for users to access funds quickly. For first-time borrowers, the loan starts at 1,500 pesos. With a good repayment history, your limit can increase over time. Next is Loan, offered by GCash. With Loan, you can borrow with ease and borrow directly from the app. Your starting credit line is around 1,000 pesos, but it can increase as you use the app more and maintain a good score. These fintech apps give Filipinos easy access to cash. They are fast, accessible, and convenient, making borrowing easier than ever before. But not all lending apps follow the rules. Some even got into trouble for unfair practices. Cases when online lending companies were penalized. In 2019, the Securities and Exchange Commission and the National Privacy Commission launched a massive crackdown on illegal online lending apps. Borrowers reported harassment, chats, and even contact shaming. Some users even receive unsolicited loans without filing formal applications. So, as a result, from 2019 until now, regulators ordered the shutdown of more than 2,000 unregistered and non-compliant apps, protecting thousands of Filipino consumers from abusive lending practices. Next case, let's look at recent penalties in 2025. The SEC fined L Online Lending Incorporated, operator of the apps L Lending and Pautang Peso, a 129 pesos for misleading loan terms and violating the Truth in Lending Act. The Credit Lending Linking Corporation, operator of the apps iPeso and PesoIn, was also fined 1 million pesos for unfair debt collection, after borrowers reported harassment through threatening messages and even contacting their family and friends. So, what lessons can we take away from all of this? Transparency and clarity. Ensure that all lending terms, fees, and conditions are explicitly stated and easy to understand. Misleading advertising can lead to regulatory penalties and reputational damage. Understanding regulatory frameworks. Familiarize yourself with federal, state, and local lending laws and regulations. Compliance should be a core aspect of the business strategy to avoid surprises and sanctions. Responsible lending practices. Implement responsible lending guidelines that assess borrowers' ability to repay loans. Avoid predatory lending practices that target vulnerable consumers. Customer support and communication. Establish robust customer support systems to address borrowers' concerns and inquiries promptly. Transparent communication can build trust and mitigate complaints that may lead to regulatory scrutiny. Data protection and privacy. Adhere to data protection regulations like GDPR in Europe and CCPA in California to protect consumer data, ensuring data privacy not only builds trust but also satisfies legal requirements. Regular compliance audits. Conduct ongoing compliance audits and risk assessments to identify potential areas of legal concern. Ensure that all processes are aligned with current regulations and best practices. Ethical marketing practices. Use honest and clear marketing strategies that do not exploit consumers' lack of knowledge about financial products. Ethical marketing fosters a positive brand image. Feedback mechanisms. Establish mechanisms to collect feedback from borrowers regarding their experiences. Use this information to improve services and compliance efforts continually. Training and education. Provide ongoing training for employees on compliance, customer service, and ethical lending practices to foster a culture of integrity within the organization.
Collaboration with regulators. Engage with regulatory bodies to stay updated on changes in laws and policies. Being proactive rather than reactive to regulatory changes can prevent violations. Digital lending today is fast, convenient, and powerful. Technology makes it easier than ever to access credit, anytime, anywhere. But as our systems become smarter, so do the risk. Scams, fraud, and identity theft are now part of the digital landscape. That's why responsibility matters more than ever. As lenders and borrowers, we must protect trust by using technology wisely, securing data, and acting with integrity. The future of digital credit is in our hands. The path is our choice if we want safe and responsible lending.